Hello, today is Wednesday, April 13th, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I am the President and CEO of the Milwaukee Company. And joining me this morning is Michael Curran. Michael is the newest member of the Milwaukee Company team, and he will be assisting our clients in his role as a wealth manager. Welcome, Michael.
Hey, thanks for having me.
Well, we're very glad to have you both on today's podcast, and more importantly, as part of the Milwaukee Company team. Today, Michael and I are going to be discussing the U.S. housing market, and a very interesting subject with everything that's going on. But before we get started, I'd like to remind our audience that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed during this podcast. And I also want to remind them that today's podcasts are Michael and my personal views and not necessarily those of the Milwaukee Company. And with that being said, Mike, why don't you begin by just introducing yourself a little bit to the audience, real quick discussion of who you are and what your background is.
Yeah, sure. So I grew up in Green Bay, Wisconsin, and a big Packer fan, as most people are in the Green Bay area.
Big part of your getting the job, by the way.
Yeah, definitely. Before joining the Milwaukee Company, I worked at my father's investment management firm, where I oversaw the development of the investment strategies and managed client portfolios. I later moved into the president role to explore exit strategies to sell the company's advisory book of business. Before that, I held a couple positions, some large financial firms that provided investment management and insurance and some other financial products and services to both retail and institutional clients.
So that's great, Mike. Thank you for that background. And for those listening who are clients of ours, Mike will be one of your contact people that you can always reach out to if you have any questions about your account or anything relating to your account. And he's also going to be helping our clients with more financial planning and that kind of thing as well. All that getting said, now, Mike, let's talk a little bit about the residential real estate market in the United States. And I think it's fair to say that the real estate market's on fire. What do you think are the primary drivers of the housing market rally?
Well, I think a lot of it is, the basic economic supply and demand. There's not a lot of supply and there's a lot of demand. I think a lot of the people that live in the city, I am one of them, live downtown, and my wife and I are looking to buy a house in the suburbs. But I think a lot of it is, the credit worthy, the buyers are, it's nothing like the 2008 subprime deal. I think there are more people that are saving and looking to buy. But then also, with the restrictions downtown, people want to be able to get outside during the summer and not being trapped into their apartments or condos. And then, also the working from home opportunities that are increasing when you don't have to commute and you can just kind of just stay in your PJs and wake up, have a cup of coffee, and then jump right into work. The suburb life is very appealing.
Yeah, and you mentioned, Mike, that you and your wife are looking for a house, and you're what, in your early 30s? Am I got that right, or
late 20s? Yeah.
Okay, so a lot of millennials. Are you still in the millennial category? I guess you are, right? You're
Yep.
on the tail end of it. A lot of millennials are buying homes later than my generation. I'm one of the last of the baby boomers. I bought my first home when I was, I think, 24, just out of law school. But I think millennials waited longer to buy their first homes, and that's now millennials make the biggest demographic group of all. So as that demographic group is soundly into the home buying market, it's obviously, like you said, demand is increasing. And that demand is also impacting housing prices, as we've seen. The latest Case-Shiller index for home prices shows an 11% increase year over year.
Hmm.
And part of that's supply and demand, but I'm assuming that that's not the only reason.
No, I think prices are rising for the right reasons. There's the latest housing boom. There's kind of that bust caused by home builders. So to pull back on the numbers of homes they build, and I
Okay.
mean, like you said, my generation, the millennials, are now the biggest demographic in the U.S. And your generation, you bought houses early on in your careers, when you were younger. And I think for people my age, we put off buying homes, due to multiple different factors. Like we went to college. There's more people now that have a bachelor's degree than any time before, and the financial crisis in 2008 that also delayed certain people that were on the verge of buying a home, but now they had to rebuild their credit, but then also rebuild their savings. And to be honest, I think a lot of us, we just didn't feel like growing up.
Yeah, I mean, it was comfortable. It was easy to stay at home with the folks. And I do think, when you talked about the hangover, you're right. The 2008 housing, the whole housing market crash that occurred following that boom that preceded it, did put home builders, made them a little more weary about buying homes. And I think so the supply is constrained because there haven't been as many being built. And I think, the home buyers are in better shape financially than they've ever been coming out of a recession. I mean, saving rates are at all-time high, mortgage rates are at all-time lows, and wages for potential home buyers, are strong. So you put all that together, and you're going to see home prices and the housing market rally.
Absolutely.
And so, what do you think about how can our people listening to this podcast participate in this rally? I mean, what are some of the ways you think they can get in on it,
Well, one of them would
benefit from
be, invest in REITs. Those are real estate trusts. So one thing that I like to look at is some healthcare REITs, because they focus on the, I guess, hospitals and also long-term care buildings. The other one would be the home builder stocks. So Home Depot and Lowe's. Those are some good ones. Just because even if you're not, um, you know, doing not building a new house, you will be, if you already own a house, you're at home and you look at the ceiling and you're saying, oh, I have to paint, or I have to fix that crack. Well, you're going to go to Home Depot and you're going to get the materials you need to fix that, or contact a contractor, and you're going to have get lumber or get other materials that would increase those construction costs.
Well, you're right, and those stocks have seen a benefit in this most recent rally. They've done quite well. Myself personally, I kind of prefer investing in, instead of picking individual companies,
Hmm.
because there's so much specific risk whenever you involve yourself in an individual company. My personal preference is to try and focus on ETFs that track an index, and because they have a broad range of companies in that particular sector that are in the fund, so one is not as likely to upset the investment. If one has a problem, the rest, it's not usually a large enough percentage of the overall fund to cause a big problem.
Absolutely.
And one of them, for example, you have the iShares U.S. Home Construction ETF.
Hmm.
It's a symbol ITB. That's just one of the many that you can, or one of the several you can consider. And then there's this, I don't know much about it, to tell you honestly, but I've heard about it, this relatively new way to invest in real estate through crowdfunding. Do you know anything about that by chance? Or
I mean, I've heard a little bit just because of there's some stuff online, just to get people that aren't, that don't have thousands of millions of dollars to invest in real estate. You can put in a little bit and be a kind of part owner of certain things. So that's the only thing I really know, about them. So I think it's a great idea when people that the little guy can actually invest in certain things that have been more or less the big ticket items.
Yeah, well, yeah. So I guess the way it works is, we all, and most of us are familiar with crowdfunding, where you go on a website, you try and raise money. Sometimes it's to help someone has a particular need, or sometimes it's to invest in a business idea that someone's come up with,
Yep.
and in the real estate arena, there are people who are, maybe you don't have the expertise to go and identify a good commercial project, but you'd like to participate in one. Well, the traditional way of doing that was to invest through partnerships. Master limited partnerships that invested in real estate or that sort of thing. But you had to be connected. I mean, these partnerships weren't something that were publicly traded. So unless you had the right contacts, it was hard to do it. But with this crowdfunding online, anybody can say, "Hey, I have this project. I want to build this buy this apartment building, or this maybe something as simple as a duplex or whatever." And anybody can invest in it in much smaller amounts of money than you would normally have to come up with if you were going to invest in a partnership. And the other thing I want to mention is, this idea of trying to time the housing market is something that I've heard a lot of people talk about. They're saying, I don't want to buy a house right now. I want to buy a home, but I think interest rates are going to go up and that'll drive housing prices lower, and I'll be able to capitalize on that. And I just want to caution our audience that it may be tempting to try and time the housing market and to buy when the proverbial dip comes, but really there hasn't been many nationwide declines in housing prices over the past 34 years or so. And so if you think timing the stock market's hard, which I think it is, timing the real estate market, a housing market in particular, can be even harder. And the other thing is, we talk about specific risk of individual companies. We just did. Well, specific risk in buying a home is even greater than it is in investing in a particular company, because there's so many factors that go into determining a home's value, like the city, the community, the neighborhood, the school system, location.
Absolutely.
You got the age of the home, the amenities, the design, the quality of the home, its condition. So my advice is, if you're and it looks like you're doing this yourself, if you want a home, that's something you want to invest in, and you're in a position to do so financially, it may not be a good idea to wait for prices to fall before you make that decision. Michael, we've talked about the fact that the housing market is doing quite well right now, and that it's been a positive development for the economy. But what do you think might be what could threaten the housing market rally? What could occur that might be a negative in terms of housing?
I think a sharp rise in interest rates, incomes that fail to keep up with the housing prices. I would say probably an economic downturn, just based off of how skittish the markets are with anything that has to do with the pandemic. And then there's too much demand, so builders can only build so much. So I think those would be the key factors that would be, I guess, the biggest threats.
Right. In terms of the housing markets, I guess I would say that you'd be more concerned perhaps with builders overdoing it, right? I mean, if the supply gets to be too great, right now we've had a shortage in supply, And so housing prices have reflected that, supply and demand being, as you mentioned earlier, being the key to determining pricing. But if supply increases too much because builders are saying, wow, look at these profit margins, we should be building like crazy.
Mm-hmm.
And they do. And then all of a sudden demand can't keep up with that increase in supply. That could be problematic too. So very good. Well, I think that should about cover it for now. Michael, thank you again for joining us, and thank you all for listening today. I'd like to remind our audience that they should please keep in mind that they shouldn't act on anything they've heard in this podcast until they discussed it with a qualified financial professional who is familiar with their personal situation and investment objectives. And with that, I'll say have a great day to both you, Mike, and the audience.
Thank you very much. Thanks for having me.
You're very welcome. Bye now.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.